Hey, welcome to The Explainer. Today, we are diving into a topic that affects pretty much every global brand you can think of: transfer pricing. It's this really complex, sometimes controversial world of how huge multinational companies get taxed when they move goods and services across borders. So let's get right into it. It sounds like a riddle, doesn't it? But this question, it's right at the heart of what we're talking about today. I mean, just picture a company that's so massive, it's operating in dozens of countries. So, how does one part of that company over in, say, Germany, charge another part of that same company in Brazil? Well, the price they set for that internal sale, that's what this is all about.
Okay, so what is transfer pricing? To put it simply, it's the price that one division of a company charges another division for goods or services. Now, to make this super clear, we're going to use an analogy and stick with it. Imagine a giant coffee company. This company owns coffee bean farms in one country that has really low taxes, and it also owns a chain of cafes in another country with much higher taxes. So you see, whether it's coffee beans for a cafe or raw materials for a factory like this one, the price that one part of the company pays the other, that's the transfer price. And listen, this is way more than just some boring accounting detail. This internal price is absolutely crucial because it determines where the company officially makes its profit. Is it in the low-tax country with the farms or the high-tax country where they're actually selling the coffee?
And that brings us to, well, the billion-dollar question. Literally, how do tax authorities make sure this internal price is actually fair? How do they stop companies from just setting a super low price to shift all their profits to a tax haven, leaving almost nothing to be taxed in the countries where they're actually selling stuff to people like you and me?
Well, the answer all comes down to one single core idea. It's often called the golden rule of international tax, the arm's length principle.
Okay, so the arm's length principle basically says that the price between two related parts of a company has to be the same as it would be if they were two total strangers negotiating in the open market. In other words, one side can't have any control over the other. It's really the ultimate standard for fairness in this whole game.
And this, right here, shows you exactly why this is so critical. See, on the left, our coffee farm and our cafe, because they're part of the same company, they can basically set any price they want, maybe to lower their tax bill. But on the right, two independent companies would have to battle it out and agree on a fair market price. The arm's length principle is what forces the companies on the left to act like the companies on the right. So how do governments and their auditors actually make this happen? I mean, how do they enforce this? It's not just guesswork, that's for sure. They follow a really specific, structured process. Let's take a look at the checklist an auditor uses when they examine a company's transfer pricing.
As you can see, auditors follow a really clear 5-step process that's pulled from official guidelines. So let's walk through them. First, they have to confirm that a special relationship even exists. Second, they review the company's transfer pricing documents. Third, and this is a big one, they map out what actually happened in the transaction to understand its real economic substance. Fourth, they analyze how it compares to a deal on the open market. And finally, they select the right method to calculate what a fair price should have been. We're going to break each of these down.
All right, so everything kicks off with step one, identifying a special relationship. An audit can only even start if one company has control or significant influence over the other. As the source material puts it, this relationship is the very entry point for any transfer pricing analysis. Without it, there's nothing to investigate.
Step 2 is looking at the documents. Companies have to prepare this massive amount of paperwork. It's often called a TP doc. But here's the thing. Just having perfect paperwork isn't a get-out-of-jail-free card. Auditors are trained to look beyond the contracts, to see the economic substance of a deal. They're always asking, what really happened here? And that takes us right into step 3, mapping the transaction. This is where it gets really interesting. Check out this real-world example from the training materials. So here, a company in Jakarta sent some goods back to its parent company overseas. Now, on their books, they just called it a simple return of merchandise, which is a non-taxable event. But the auditor dug a little deeper and found something else entirely. The parent company never actually returned any money. Instead, it used those so-called returned goods to fill an order for a totally different customer. So economically, this wasn't a return at all. It was a sale. And a sale, that's a taxable event. By just recharacterizing what the transaction truly was, the auditor uncovered taxable income that was being hidden.
Okay, so once the auditor figures out what really happened, how do they decide if the price was fair in the first place? This brings us to the final and really analytical steps of the whole audit. That's where step 4 comes in, the comparability analysis. What an auditor does here is find a similar transaction, but one that happened between two independent companies to use as a benchmark. And to make sure it's a true apples-to-apples comparison, they have to meticulously analyze every single detail. We're talking contractual terms, economic conditions, who did what, who owned what, and who took on which risks. Every one of these factors has to line up for the comparison to be legit. And finally, we hit step 5, where the auditor picks a pricing method. Once they have a good comparable transaction, they use an internationally accepted financial model to calculate the correct arm's-length price. For example, they might use a simple cost-plus method for a basic manufacturer. But for a really complex deal where both sides bring unique patents or technology, they might need a profit split method. The goal, no matter the method, is always the same: find that fair market value. So we've been deep in the weeds with all that detail. Let's zoom out for a second. Why does this incredibly complex process matter so much? Why do tax authorities all over the world pour so much time and money into getting it right? Because we're not talking about a few $1,000s here or even millions. We are talking about billions. The transfer prices set by these huge multinational corporations directly affect the tax revenue of entire countries. That means they influence how much money governments have for public services, things like schools, healthcare, and roads. At the end of the day, this whole complex world of transfer pricing really boils down to one simple idea: fairness. It's a tool that governments use to make sure that the world's biggest companies are contributing their fair share to the economies where they actually do business and make their money. It's all about protecting the local tax base in our globalized world. And that kind of leaves us with one big question for the future. In a world of digital services, things you can't touch, like brand value and data, and these unbelievably complex global supply chains, the very idea of a simple transaction is changing. So the big question is, how will our definition of a fair price have to evolve right along with it? Thanks for watching.